I'm glad the rain has brought us an audience because we really have an aggressive group here today to talk a little bit about the emerging IPO market. And I think as Charlie will help and Jeff will help guide us, I think we're still at the emerging side. So let us all introduce ourselves. Jeff, do you want to start?
Hi, I'm Jeff Thomas, Chief Revenue Officer and Head of Global Listings at NASDAQ.
Charlie Black, Managing Director at Goldman Sachs. I focus within our technology equity capital markets business, so I take companies public.
Hi, I'm John Elbi. I'm partner and CIO at Nahmani Grunder. We are a multifamily office based in Switzerland with $9 billion of assets.
Excellent. And I'm Nicole Brookshire. I can't even pronounce my own name today. Nicole Brookshire. I'm a partner at Davis Polk. I represent late stage and companies, take them public and then represent them public. Companies like MongoDB and Datadog and Etsy and folks like that. So what we're going to try to do is take apart some of the pieces of the equation for setting the stage on sort of how the IPO market looks. We're going to cover sort of where we are currently, sort of the criteria to go public, what's changed recently and what's sort of stayed the same, the size and scale of the private market and how that's influencing the IPO market generally, where we are from a valuation perspective, lessons that maybe we can learn from other markets that will play into our own, and really how to optimize. If an IPO is a strategy that you want to consider, how do you ensure that you have success? And then lastly, we'll cover some regulatory shifts. So Charlie, let me start with you on the big picture. The market last year was, I was reading Chan's website from Nahmani Grunder, which I suggest everyone check it out. It's new and it's quite beautiful and has a lot of information. And it was talking about really how 2024 was the year of exceptionalism. The biggest tech stocks continue to do much of the work, powering the S&P 500. It surged over 23%, hitting 57 record highs. And the Magnificent Seven accounted for about 53% of that. And there was just a remarkable resilience in the US economy. That hasn't played out in sort of the number of IPOs. So can you speak a little bit as to why, Charlie, and sort of what you're seeing right now at the sort of beginning Q1 of 2025?
Sure. So if we take a step back, I think last year was definitely a step up with respect to IPOs. 2021, we saw, obviously, it was a huge boom. And if you count SPACs in, I'm going to focus on tech stats here. There was 100 tech IPOs. In 2022, there was 2, right? And so that was a real winter that we kind of went through. 2 and 2 became 4 the next year. Last year, there were 12, right? So it was a nice pickup from the previous years. And this year, look, we'll talk a little bit about that, but I think kind of, if you think about a normal cadence and you exclude that 2021 period, there's 30 to 40 tech IPOs. And I think hopefully we can talk a little bit about some of the uncertainty that's coming in. We're on track to be back towards that 20 to 30, and then hopefully back to normal rate next year. Why didn't last year? You're right, if you take a step back, it was a really positive backdrop with respect to just kind of why you think companies should be coming public. However, when you look at kind of the individual factors why a company can go public and what they want to go public, you want to make sure the business is ready, right? And that's a 9 to 12 month process to be ready, right? You want to have a really strong ability to forecast where your business is going to be. So you need to remove a lot of that uncertainty. Last year with the broader election and just some of the challenges for the second half of the year, really meant the first half of the year was going to be the opportune time to go public. Now there were some. We did an IPO at the very end of last year in ServiceTitan, so we were able to catch us kind of like post the election. But you really need to have a good visibility with respect to your business. I think that's one of the most important factors when coming public. You've got to be able to forecast out 8 quarters and beat and raise for each one of those quarters. And if you miss, unfortunately, you put in the penalty box for up to 2 years, right? And so businesses need to be able to forecast. They need to be able to have ready with respect to kind of all their Sarbanes-Oxley and all the other components. And then valuations need to be right. And I think we've still, while the broader market valuations were high, we're sitting in a period where a lot of marks had been set very high from the 2021 period, and companies quite hadn't grown back into that. So unfortunately, a couple of those weren't aligning, but we have seen, because of the positive reaction, people really starting to get ready. And this year, I know we've seen one already, and there is some uncertainty out there, but we are feeling in the background a real uptick and a really surge cadence in testing the waters and getting companies ready to go public.
Excellent. Jeff, how are you thinking about, from a NASDAQ perspective, what you're seeing sort of the pipeline building for 2025? Any sectors, themes that are kind of giving tailwinds?
Yeah, we're incredibly busy right now, kind of talking to a lot of technology companies. You know, there's probably around 20 that are on file confidentially. We're tracking over 200 IPO prospects in the tech sector. But from a sector perspective, we're actually seeing a little bit more activity in the biotech space. That usually leads the way out. We've had about 10 biotech IPOs on NASDAQ so far this year. As Charlie mentioned, the big tech deal so far, SailPoint, got out. It was a private equity-backed deal. They actually increased the range and upsized the deal, so that was good for the company to raise additional capital. Stocks traded okay since the offering. And then
More of that. I did that deal.
There you go. And then we obviously saw a big S1 flip this week with CoreWeave, which is a big data center provider into the AI infrastructure space. So again, lots of positive trends there. We've also seen some deals come out in the energy and industrial sectors. We had a consumer deal with Smithfield Foods, which was a spin-out of a Chinese conglomerate. So again, it's been a pretty broad-based sector, but I think we are anticipating more offerings on the technology side as we move into Q2. Ultimately, one of the things that investors are looking for there is growth. And so as Charlie mentioned, we saw fewer companies last year than we probably would have liked. I do think some of that was, I think there were a few of those companies that were seeing kind of limited growth. We've now started to see, some of those companies see a little bit better performance coming off their 24 numbers. So I think that's one of the reasons we were anticipating a little bit more of a pickup in Q2. Companies could go out on their full 24 numbers if they were good. So I think that's driving a little bit of the cycle right now.
Great. So Jen, from your perspective, any case studies or examples you want to provide and sort of what you've seen being both a public and a private investor, just in terms of like 2024 or as you think about 2025?
Yeah, I mean, we were discussing in preparation for this section, and you asked me about IPO readiness, and I think I'm just trying to bring an investor's perspective to this discussion. I think IPO readiness as a notion is a bit of a misnomer. And as an investor, effectively, we think, or generally, there are four main value drivers to the value of a business.
Yep.
So it's revenue growth at scale, margins, capital intensity, and returns on capital that are higher than cost of capital. So any business that is well run, that can show some clarity along these four vectors, should be IPOable. Specifically within technology, just taking that one step further, types of businesses that are of interest to us are category defining or category leading businesses that have the path to become a platform company, companies that have large and expanding TAMs that gives them visibility of multi-year durable growth, and companies with great unit economics. So we have an understanding of profitability and hopefully, with low levels of capital intensity. Because effectively, if you boil all of that down, it's all about free cash flow and sustainable free cash flow growth over the long run. So that's kind of how we look at this. And I think that basically comes back to what you were saying on IPO readiness. I think the problem has been that there's been no IPOs or very few IPOs since 2021. Because although a lot of businesses have some path along these four vectors, I think valuation aspirations have been too high. So I think any company that has a path on these four vectors at the right valuation should be listable. I think that's how we look at it.
Perfect. Well, that's a great segue to one of my personal favorite topics, which is to you, Charlie, about, there's been so much, anytime we go through a correction cycle, I'm on my third one, and the last, hopefully, but is that we pivot from growth, to your point, back to profitability as a metric. And that is a very long lead time, depending on the business, to make that shift and turn. But at the end of the day, the market, as you said, pays for growth. So where do you see us as part of that unwind of the downturn from 2021, see in terms of the right sort of levers on balancing growth and profitability as you look at the companies that are scaled enough to get the right multiple, thinking about whether you're selling yourself or whether you're going public, are we pivoting back to growth?
Yeah, great question, and we have a very big pipeline that we're working on with respect to kind of potential IPOs. And this question, every founder's CFO is asking, right? How do I, as I think about the next 12 months, which lever do I pull? The market is definitely starting to shift back to growth, and we're feeling that, and the market is paying for growth, which is fantastic. I think, which is kind of point number one. Everyone's heard of the rule of 40. We often think of the rule of X, which we think is actually a better and a more helpful metric. And what that actually says is when we regress our companies and what we're paying for with respect to kind of growth and profitability, we actually find that the market pays 2 to 3 times more when the regression is stronger for growth than profitability and free cash flow. And we're starting to see and feel that.
Did everybody hear that?
Now, profitability is really important, and I think investors, as we are bringing businesses public, want to know, are you profitable? What's your, exactly as you say, it's all about free cash flow at the end of the day, right? And people want to understand where that is in the terminal year and what that looks like, and what is the path to that free cash flow. And so you need to have that in your near-term projections. Either you are free cash flow positive or very close to that, and be able to tell the story about how at scale you're going to be able to deliver a lot of that free cash flow. But if you can prove out that you're going to continue to grow, and you think about just kind of, in 2022 to 2021 period, so many companies were growing greater than 30%. It's really a handful now that are growing greater than 30%.
Right.
And it's kind of 20 to 30% of great growers out there, and you're greater than 30, you're in a very small bucket. So to go out and to be able to exhibit real growth at those types of levels, the market is paying and will continue to pay for. And I think that if you can show that and a path to profitability, you're going to come out with a superior valuation. And they're the types of companies we've seen come out, and we're going to continue to see come out. They don't need to be the Stripes and the SpaceXs of the world. If you're a $5 billion company that's growing really, really well and has the ability to prove that you have profitability and are going to continue to be profitable, the reception's been incredible. And I can think of ServiceTitan at the end of last year, an IPO we led. It was like in that range. It's a sub-billion-dollar company. It's trading kind of north of 10 times revenue, and it has a 20% growth, right? Actually slightly under with the street models. And so what a great valuation for a company, but it's all about that growth, and they have this profitability and continuing to grow at that durable growth that Cam mentioned. That's what investors are looking for. And so growth continues to be important, and that's where I think the focus will continue to be. Durable growth, I think, is the key word there, though. It's just not at all costs.
Absolutely.
Can I just give
Of
an
course,
example?
yeah.
And you asked me about an example. Yeah. I think, and again, Jamie, if he's here, he's probably going to like what I'm going to be saying. I think we're all looking for the next CrowdStrike. I was just looking at some of the metrics. CrowdStrike IPO'd in June 2019, 6 years ago. They had around $500 million of revenues, annual revenues at that stage. They're at $4 billion, 6 years, from 500 to 4 billion within 6 years. They listed at super acceptable valuations. The stock has 10x'd from 34 to 350.
Yep.
So these are venture-type returns in public markets. And the reason it works so well is, I mean, it's a platform company, durable growth. They were already free cash flow positive when they listed. Free cash flow margins have gone from low single digit to 30% in the meantime. They listed at 10-time revenue multiples at that stage. They're trading at 17, 18 times multiples right now. So you've had fantastic value creation through durable growth, high free cash flow margins, acceptable value, starting valuations, which have even re-rated further. And I think that's a great blueprint for a potential IPO market reopening.
Yeah. I think another good leading indicator is what's going on in the private secondary market. So over 10 years ago, we launched a platform called NASDAQ Private Market to help companies provide liquidity before they go public.
And you have 70% of the market in that, right?
We do. And so we've done over $50 billion in liquidity through the platform so far. And so when we started the business, we thought, well, maybe this will be a hedge versus the IPO market. If IPOs slow down, maybe we'll see more secondaries. And they're actually very correlated. Mm-hmm. So when risk capital is in the market, people are looking to invest in IPOs, but equally they're looking to invest in companies pre-IPO. And over the course of 2024, we saw a real pickup in terms of the number of company-sponsored tender offers, block sales, and just secondary transactions overall. And so we think that's a really good leading indicator. If investors are willing to come in and buy common, it's a sign that those companies are going to be highly likely to convert through an IPO rather than go through an acquisition. And so we continue to see elevated levels there. One of the really interesting trends I've seen is companies are now announcing their secondary transactions along with the valuation they've achieved, almost like it's an IPO. And so it is actually this kind of new thing. When we started NASDAQ Private Market over 10 years ago, it was a very quiet market. People generally didn't talk about it. It was something you did for your employees.
There's a lot of fear.
Yeah, and you didn't want to kind of go and kind of talk about it. Are we going to screw up our 409A valuation? All those kind of things. And now it's just become a very accepted part of the market.
Hallelujah.
Yeah, and again, well, hallelujah, except that then there's the problem with that is it solves some of the problems that an IPO solves in terms of raising capital, providing liquidity. And so then what it does is it actually gives companies an incentive to stay private longer.
But it helps with durable growth.
It does, but,
right?
but you're taking away some of those opportunities from retail investors.
That's true. That's true.
And so companies are now able to stay longer. And so that's one of the things we're spending a lot of time talking to the new SEC administration about is what can we do from a regulatory standpoint to make the public markets more attractive versus private markets.
And they made an announcement yesterday, the SEC, with some changes, which are, they're helpful, but hopefully we'll continue those conversations.
We're having a lot of discussions.
Yes, absolutely.
I think Ueda and Pierce, they've been very forward-leaning on crypto.
Yep.
They are going to extend confidential filing status to all companies. That was something we've been advocating for since 2018.
Yep.
We're really focused on things like proxy reform, short sale disclosure, harmonizing the regulatory framework to make things simpler and clearer. So we've got a whole list of topics we're talking to them about.
Excellent. So Charlie, I'm going to ask you a question that wasn't on my pre-plan list, but it is absolutely part of what we're all having conversations about at this conference and in the market writ large, which is about AI. And how AI is, certainly when we think about where lots of investment dollars are going, it is absolutely an AI and being able to productize it and leverage it in real businesses. But as you think about a business that, I was just talking to a founder this morning about an AI pivot, that pivoting their current business over to that because they were seeing so much success. As you think about more scale businesses that are trying to add AI, which I think most folks are trying to add it to their narrative, how do you think about that like the proof points, like how to get valuation? Like, does it need to be 10% of the business? Does it need to like how do you think about that from a valuation equation question?
It's a great question. I'm working on a software business at the moment. We've been doing some confidential investor marketing, and they have tailwinds and part of the business that they're transitioning through. It's been a real focus of investors. If you're going to tell me a story that is AI, I want to see proof points. And for them, it's been about ARR. And where is that ARR? Where has it grown from? Where is it? And where's it going to? This business has been great. It's been able to talk about, I'm at 100. I was at 100. I've grown to 200 over a year. And here's my projections for that over the next couple of years. Investors are very focused on kind of what that looks like. Now, the credit with respect to kind of valuation being kind of a multiple that's applied to that isn't there because it's just a little bit too small.
Yep.
But I think more broadly, you're getting credit to be on the right-hand side of your valuation range because you have this tailwind as opposed to shifting to the left. There's a real concern out there from investors. This is, are you an AI winner or are you an AI loser, right? And so I think firstly, people just want to put you in a bucket and make sure that you're an AI winner. And so as long as you can get into that AI winner bucket, that's really, really important. Because the AI loser is investors will say that, it's a challenging place to be because then you've just got to fight your way out of it. And I actually don't think anyone knows who is going to be where yet. But I think if you have a narrative and people can put you in this bucket, you've just got to spend a lot of your time fighting your way out of it. If you can be seen to be a winner and then just show a few proof points, it just really helps with respect to your story and where you sit along that valuation curve.
That makes sense.
One of the things a lot of people don't know, so everybody knows NASDAQ is the leading US equities exchange in the US, and we are. But we're actually a publicly listed company on NASDAQ as well. Did about $4 billion in revenue last year, and we did about $1 billion in SaaS revenue. So we're a scaled financial technology provider.
Sorry, talk more about that. Where's your SaaS revenue coming from?
Yeah, so we have done a number of strategic acquisitions over the years. So we sell SaaS products and services to corporates to help them optimize their performance as a public company through investor relations, corporate governance. We help asset managers through platforms like eVestment to help them find their next great investor. And then we've done a series of acquisitions of technology into the financial ecosystem.
Okay.
Companies like Verafin that do fraud and anti-money laundering, Calypso that does treasury management, AxiomSL that does regulatory reporting. So we have a really diverse set of software assets. So when we think about
That's
AI,
a secret. I'm a software lawyer. I didn't know that.
we're trying to tell a better story. But when we think about AI at NASDAQ, so we think about it in two ways. We think about it in the product and on the business. And in the product, there's going to be opportunities to apply AI to our software businesses that are going to help accelerate revenue growth. But we also think about it as a defensive position. If you have a competitor that offers it, you may need to do that just to retain your revenue.
Yep.
And then we kind of look at 25 as the year of operations around kind of using AI on the business to create more efficiencies in our ability to scale.
Well, that's the holy grail, right? Which everyone's
And
trying to do.
this is the hard part, right? So how do you kind of get that actually out of the experimental phase and into the operation phase?
Yeah.
And so we've got a number of great partners on that front to try to achieve some of that scale.
That's awesome.
Yeah.
And so do you buy technologies from folks like here? Jan, can you just speak a little bit about, I loved your CrowdStrike example. I mean, CrowdStrike is the holy grail of performance, right? Like that's Mount Everest of really achievement. But it sounded like in our prior conversations that there's maybe some examples from European listings that you've seen that have been successful that maybe we can extrapolate some of the lessons from there to the United States.
Sure. I mean, there have been a number of successful European IPOs in 2024. And I think the common denominator on why they were successful, there's a company called Galderma, which used to be owned by Nestle. It's a dermatology, skincare, aesthetics company.
Yep.
Nestle being Nestle, sold it off to EQT. So it was private equity owned. And the stock has more than doubled in a year. So they IPO'd in early March last year. Great business with the biologics angle as well, with a new division potentially launching this year. And I think the reason why it worked so well was, first of all, EQT sold very few shares.
Okay.
There was a primary component because the company wanted to delever.
Yep.
So EQT continued to own more than 80% of the business.
All right.
So there was very limited refloat. The largest owner sold no shares. The valuation was super interesting. So comparing it to the L'Oreals of this world, I mean, there was a 40% discount on the valuation. So, and the company came out, continuously hit their numbers. L'Oreal came in and bought 10% of the company, of EQT,
Okay.
which was a validation on their underlying
Absolutely.
science
Yep.
and technology.
Yep.
So I think that's a great blueprint. I think valuations are very important. Coming back to what you were saying, I personally think, I mean, is AI an opportunity or a threat? I think it's more of a threat to technology IPO market because, the infrastructure layer, I think, is more certain.
Right.
But all the other layers in the tech stack are potentially being disrupted by AI.
100%.
So it creates a lot of question marks for the whole IPO funnel as well, I think. That's my personal view. But again, I think this Galderma example, and there are a number of other ones, is potentially a good blueprint because I think free floats have to be limited. The primary owners have to remain vested.
Right.
And the valuations have to be interesting such that I think the new investors have some returns to grasp from this as well. And I think, if you look at the two latest US tech listings, ServiceTitan and SailPoint,
Yep.
I think if you contrast these two, ServiceTitan pretty much fits the bill in terms of what I described.
Right.
Category leading, potential platform business, large TAM,
Yep.
already free cash flow positive.
Yep.
It's been a successful IPO.
Very, up 25%.
And I think, the free float is limited, around 10%.
Right, yep.
Whereas SailPoint, which I think was a Thoma Bravo one, is
Right.
less so because I think there are some contentions on the identity market. It's getting more and more competitive. CrowdStrike is becoming a player. And I think the valuation was not particularly exciting, at least to my viewpoint. So I think, again, these are potential points in terms of how this market could potentially come back. But I know that there are like 7, 8 companies ready to list in the US with 10 billion plus valuations. So I think it's going to be important to see how these deals are structured.
Yeah.
On the AI front, I'd be curious to get your perspectives, because one of the models I've kind of read a little bit about is if you look back to the mobile revolution, right? There was kind of the chip companies, the handset companies, and the app companies. And that was kind of the order in which value was created. It was initially, a lot of it accrued to the chip, and then it was the handset, and then it was kind of the application companies. I've heard people kind of talk about it the same way in terms of AI, right? You've seen a lot of value accrete to the chip companies. We're now seeing some of the infrastructure companies, pursuing it, and the apps, I think, are a little bit more uncertain. But, from your perspective, is that a good way to think about it, or is there more nuance there?
I'll come back to, I've been coming to the Montgomery Summit for a number of years now. We are large LPs in Jamie and Suman's funds. I think we've had a relationship since 2018. 2 years ago, Charles Lamanna from Microsoft held a great keynote. And it stuck with me, and I think one of the key statements from his presentation was, we're moving from a world where software is eating the world, where AI is eating software. And it stuck with me. And I saw effectively, in that type of world, I think the application layer being a system of record, having to move to a systems of intelligence, is going to render a lot of businesses that had some value creation, that were probably have been waiting to list, as being disrupted. That's creating a lot of uncertainty, I think, in investors' minds. And I think that's why the analogy doesn't completely hold in my view.
Perfect. I completely agree there. I think there's this disruption, and that's why software's just had a really tough time coming out. I mean, ServiceTitan was great, and I think there was absolutely the view in investors' minds that AI is going to help this business. It can't really be disrupted when you think about its core offering and what it does, and really expands the offering. There are so many different software businesses out there where you can very quickly come up with a story about how they could be eaten away and the changes and challenges that they're going to face. It brings me back to my earlier point. If you want to go out and list, you have to be able to give with certainty your next 8 quarters beat and raise. And if there's any uncertainty associated with where AI could come or anything that's going to disrupt your business and you can't give those beat and raise quarters, and you go out and you miss, we've seen companies fall sometimes 20, 30%. It all depends. And then just put in the penalty box for up to a couple of years while they work their way out. And I think management teams acknowledge that and are concerned if there is going to be something disruptive, where they'll just stay private for a little bit longer, see how this is going to play out, and make sure they have that uncertainty removed before they go public and potentially face this challenge in the public markets, which is really, really tough.
Absolutely. Charlie, given this is sort of your area of magic making, can we talk a little bit about what you were speaking about valuation and sort of the art of a deal in an IPO, and which it is an art, right? It's not a precise science, but I think that sort of the aftermarket performance and how to ensure an aftermarket performance, how do you, as sort of running deals, think about that right balance and alchemy? Because I think it's very different than a private financing. And folks coming into that process for the first time may not realize sort of like, it's not just the pricing of the deal, it's how it's going to perform in the aftermarket. And as sort of you, as sort of the deal captain, how do you think about that?
So the pros, it's so important, and I think it comes down to it's valuation. There's going to be float, and then there's investors, right? And what is that? What are those investors? Believe the company's worth in their short and long term, and what are the targets of those investors? Are they long-term investors? Are they short-term investors? So are they selling or buying? I think the way that we have evolved the process is majority of the IPOs that we've done over the last 3 years, and as I mentioned, they have decreased from where we were a couple of years ago. If I rewind 10 years, we would effectively go and do a roadshow, and that was the way that we would do an IPO. So you would be ready, and you would just launch an IPO, and you'd go spend 8 days on the road, and you'd build your book, and by the end of that, we'd have price discovery, and we'd list the company. Now we are spending ourselves doing 2 to 3 rounds, and sometimes more, of testing the waters meetings. And that's with up to 50 investors, and again, sometimes more. And so management teams are spending a huge amount of time in those 6 to 12 months before actually going public, telling their story with investors. Like I said, up to 50 investors meeting with multiple times. You're telling your story, you're really building that relationship. And it's two sides. The investors are getting to know the company, and the company is getting to know the investors. The IPO is the first and only time you'll actually get to pick your investors. Once you're a public company, you have no control over that, right? And so being really thoughtful around this is a two-way street. But through this process of multiple rounds of engagement, we found a lot more discovery with respect to kind of understanding the business and the depth of that understanding. And through that process, a lot more dialogue with respect to kind of where price discovery is. Now, there is an art around, you want to make sure that kind of you're not leaving too much money on the table. You do want to ensure that you can generate returns for investors over time if you deliver on your objectives. And so it's a lot of time, I think, kind of as we kind of put all this together through this dialogue, through 50 plus conversations with investors and all the work that we do internally, kind of understanding how investors behave, who buys, who sells, who has targets that are short term, who's long term. How do we allocate this IPO to ensure that not too much supply is coming if it does push with respect to price? And really just gathering as much information as we can privately is helping us set this up for success and ensuring that valuations are kind of in the range where everyone, I think, is going to find them acceptable. Now, do we always get that right? No. Do people often kind of act a little bit differently? Are there external factors which make this more challenging? Yes, which is why it's absolutely an art and not a science. But through a lot more prep and time, working through that prep, we've been able to mitigate this and at least get a little bit more line of sight with respect to where this goes versus, like I said, 15 years ago when I kind of was starting to do this, it was all on the road. And you'd basically go out and meet people then. As I'm sure you remember, you'd do it very quickly, and you just weren't as prepared with respect to the variation of outcomes. Now we do a lot of work to see kind of what that probability and distribution looks like to help us mitigate those risks.
Yeah,
One of the big questions that you get around an IPO is, stock pops, and there's this whole talk track of, the company left money on the table. And it's true. But one of my favorite quotes, I was talking to a CFO whose stock shot up 30, 40% after the IPO. And I said, are you mad you guys didn't go for an extra $1 or $2? He goes, no, because we priced the IPO based on my model for growth that I feel comfortable with. And as you kind of talk about, Charlie, like having those 8 quarters mapped out with a beat and raise, you've got to remember, if you go public at a higher price, you're implicitly saying to investors, we think we can do better than our model. And so that was one of the kind of counterpoints to that. The media loves to kind of talk about, you left money on the table. But at the same time, you're also maintaining that expectation with your investors that are coming into the stock and kind of setting a bar that you think you can live up to.
Yeah, and look, there's other reasons why it pops, right? We went to the Reddit IPO last year. You can't tell what retail's going to do, right? We can do a lot of work with spending time with square bracket, insert long only, or hedge fund kind of that we could all name. But if there's a big retail following, and some of this kind of works its way through, that's challenging to forecast, and you've got to hope that you spend enough time educating and working with management to understand some of these variations and the unpredictable nature of those.
Right.
And we've just got to be able to, some of them will work their way through and some of them won't. You just got to kind of work through that. So there is some of that that's uncontrollable, and we've just got to be ready for that. And that's, again, why it's this is more of an art. We base a lot on experience and kind of what we've done to date, as opposed to a perfectly predictive model.
Right. Well, and I think Charlie, so go ahead.
It's art, but art with some infused common sense.
Yeah.
Because I want to give you another, I'm sure you're aware of it because you guys were involved in it, but if you contrast CrowdStrike with Snowflake, it's an equally amazing business. I mean, they've also taken their annualized revenues from 500 million to 3.6 billion. So a very similar revenue growth journey between CrowdStrike and Snowflake. So CrowdStrike is up 10x. Snowflake is up only 40% in 5 years.
Right.
And the only difference is starting valuations. CrowdStrike was priced at 10, 11 times revenues. Snowflake was priced at 35 times revenues. Their multiple has gone from 35 to 12. So one has seen massive re-rating, and the other one has seen massive de-rating in valuation. And that ends up in, the business is doing very well, but the stock performances have been completely black and white contrasted.
Great example.
That's a very good example, yeah.
valuation matters. And so, Charlie, I think speaking to the testing the waters and how that really, I remember when it was adopted, and all of us in the market thought, well, only the weak deals are going to do this, right? Only the weak deals are going to go and test the waters, and it's become such a crucial piece that every deal does, right? I'd say the other dynamic that I'd love your thoughts or any of your thoughts on is that part of that sea change that testing the waters gave the market, which is the freedom to go out and really test the waters and see, is there a market here for this security before we go out and try to price a stock, is that I feel like it's had a trickle back effect to people starting to go into, CEOs and CFOs starting to go into to talk to the crossover investors and the public investors well in advance of an IPO process, to really start setting, fundamentally, investors buy people. They buy technology, but it's all driven by do they believe in the team, right? And so can you talk a little bit about that sort of, even before you mandate, Goldman, going out into the market and really having people understand who you are in the ecosystem relative to competition and really coming and delivering very high-level proof points so that you can come back and build to that sort of durable model far in advance of, I feel like the pricing these days is not reflective, as you said, of like 2 weeks of work. It's reflective of years of work.
It's a great point. I think conferences like this, the conference schedule has become so important with respect to, and look, it shouldn't be, I personally think sometimes the shotgun approach doesn't work, being targeted with respect to kind of the way that you do this, but being at the conference schedule, ensuring that you're kind of getting your name out there, meeting with people early, I think is really important. I think one of the most important things, and we do see there'll be non-deal roadshows where you're meeting investors. I think the great management teams also start to, a year before they're public, actually present to their board as if they are public. So every quarter presenting their earnings, walking through that, having Q&A. So by the time that your first earnings call comes up as a public company, you've done this 3 or 4 times with a board who hasn't been lenient on you, who's really pushed you for Q&A and ensuring that you've been able to deliver. Those are some of the kind of the playbooks in terms of not only meeting with investors, and there is a lot of that going on early, conference schedule, non-deal roadshow, kind of getting your name out there. The crossover around investors are important, but I think they need to be important they are important, but it's not needed, right? I think you need to have a reason to be going and diluting your existing shareholders or kind of pulling secondary off the table. Sure, if it's been a really long time horizon and people understand why, that makes sense. But if it's looking for potentially the perception that someone's just trying to kind of liquidate and monetize early than they maybe should have, it can have negative impacts, right? So really, you need, for a crossover round, they're very helpful. You get really great investors in, but it still needs to be the right reason. It can't just be a precursor to kind of having a great IPO. There needs to be solid fundamental reasons for that. But I do think other elements, prep work, conferences, non-deal roadshow, are really, really helpful as you kind of get your name out there. The one thing that is important with respect to that journey is investors have long memories. And so just ensuring your story doesn't change through that. And you see, as I'm sure you see that, you'll meet a company and 2 years later, if they're going public, people take notes all the time. And unfortunately, I've seen many stories where if the story has changed too much over those 2 years, it can actually hurt you to have kind of gone and given too much away. So I think being thoughtful about what you disclose in those 30-minute fireside chats is really important, so you can lay the breadcrumbs to continue to build that story and not show that you kind of pivoted or tweaked too much along that way. Now, everyone wants you to build and grow and kind of move with the market, but you need to lay breadcrumbs to kind of be in this continuous upwards trajectory and not show a story that's changing along the way, which can actually be harmful for some businesses.
Yeah, and I'd highlight as part of that, it's important to keep the story kind of consistent, but be really mindful about what metrics you disclose. Because once you put it out, it's very hard to pull it back. And so if your business does pivot or change, and all of a sudden a metric that you disclosed, in one of those NDRs or test orders isn't, looking as good, it's hard to pull that back. Yeah. So.
Stay high level, right?
Well, yeah, it's been, in the first meetings, your business is so big, there's so much exciting stuff to talk about. You don't need to dive too deep into it. Get people excited. Talk about exactly that. TAM, durable growth, how you can become a system of record, and really kind of how you're differentiated and your moat with respect to that. That's what people want to hear and get them excited, and you can grow from there.
Excellent. So Jeff, can you talk a little bit about, we touched on it already, but just sort of the America First investment thesis and sort of where we've seen some changes, but what are you feeling most optimistic about that really may unlock the opportunity for more businesses to pursue a public offering?
Yeah, I mean, I mentioned it before. The SEC has taken some steps to start looking at how they can reduce the regulatory burden on companies looking to go public. I think, you know, the U.S. has the broadest and deepest capital markets in the world, but we like to say every foundation needs some maintenance. I think we have, over time, stacked up a lot of complexity in the regulatory environment, and that creates a lot of complicatedness for companies as they think about how to manage through that. So, you know, if you look at things like the proxy process, it's enormously complex for companies to communicate with their shareholders around issues. It's very easy for companies to put different initiatives on the proxy that can be very time-consuming and expensive. It's the number one complaint we hear from public companies. You know, the second is just the regulatory regime that the SEC has put into place. Again, they've kind of layered regulation on top of regulation where it's not always very clear how those things intersect. I think Commissioner Pierce has been out publicly saying even they need kind of Venn diagrams to figure out what type of reporting scheme a company fits into. So we think there's a big opportunity to kind of harmonize and streamline a lot of that. And then I do think that there's a lot of work that we can do around disclosure. It's the kind of hallmark of the U.S. capital markets. But we can also always have to look at what are we asking companies to disclose? Is it material to their business? And so are there areas that we could pare back some of that disclosure where it's not material and something that investors are asking for on a regular basis? So those are a lot of the areas we're really focused on kind of talking to the commission about to try to continue to maintain the U.S. Capital markets, you know, leadership position. I think we've been, you know, the envy of the world for a while. I've had a lot of companies from Europe looking to come list in U.S. markets because they see higher valuations. We've had a lot of IPOs coming out of Asia Pacific. So again, we need to kind of think about how do we maintain that leadership position.
Absolutely. Charlie, we talked at the beginning about, I think Ken was mentioning just how many $10 billion plus businesses, right, that are, like we just had the example of CoreWeave, you know, flipping public yesterday, which basically means they're in their seasoning process for the SEC will go look at all what the press writes about them, and then they may raise additional comments, and then they're able to launch their roadshow in a couple weeks. But how do you feel about it and life sciences is its own area, but do you have to be a mega cap? Like, do you feel as part of this unwind, as we start to see more deals that, like, will we ever go back to $100 million ARR businesses being able to go public in the technology sector? Or, you know, how do we think about, you know, where we might ultimately land if we get back to the new normal? Will the new normal be just you're going to have more scale?
Yeah, it's a great question, and I think, look, start by saying you don't need to be a mega cap company, right? And I think, and we don't need a mega cap company to come out and to then have a successful IPO market. I think we've seen that smaller businesses can come out, but I do think your question. So firstly, that we don't need to have that. I think it's going to be helpful. I think some of these big companies that have access to all the capital that they need. They've got the branding event. Their employees are happy. So for them, some of them staying private, they may stay private for a little bit longer. Will we be in a world where we're 100 million ARR? I don't know in the future, but we're not there yet. If you think about where the investor universe is really broken down, I think it's kind of about where the allocation of capital is and kind of just the size of different investment teams within a lot of the funds. I think that small and micro cap less capital allocated to it, so it can be a little bit more challenging. This kind of a mid to SMID, kind of like call this $5 billion, is definitely an interesting universe, and you're able to garnish a lot of attention from investors, especially as investors are able to say, well, you're going to come out in our SMID and grow in, or small and grow into our SMID, or you're going to come out in our SMID and grow into our large cap, and so you can capture multiple PMs. What does that look like is really challenging, but I think we've seen really successful companies call it $500 million of revenue, and then just thinking about kind of, it then depends on where your growth is, where your profitability is, and then what valuation you're expecting. Does it need to be 500? I think smaller companies with a really strong profile and growth and proving their ability to win can absolutely go out, and then companies that are bigger as well go out all the time. So I think there's a spectrum. I don't think you need to be really big. You do want to have scale, as I mentioned, to be able to prove out that your business model is going to be a winner, but then also just where you're targeting in the investment community. There are great small companies out there, but 60% of the PMs at Fidelity won't be able to meet you if you're too small because you're just not going to fall within their mandate. And as you get smaller, maybe only 5% or 10% of them can meet you. And therefore, you're just missing such a large chunk of the investor universe. And as you go from fund to fund, you're going to continue to see that. And so that becomes the challenge is how can I garnish and where can I find the greatest demand? And often we find that leads us to be kind of, in addition to fundamentals growing, be kind of a really durable and large company over time, which investors can we target and focus on? And it usually starts to be in that kind of, call it 5 billion plus, growing from there. Plenty of companies successful go smaller. You've got to prove that you can grow there.
Yeah, very helpful. Well, thank you, gentlemen. It's been a pleasure chatting with you all.
Thank you.
Thank you.
Thank you.